Our next guest examines trimming positions in Apple and Amazon and leaning further into NVIDIA and Tesla. Ben Snider, Goldman Sachs senior U.S. equity strategist, joins us right here on set. Ben, welcome.
Good to be with you.
YOLO? Is this a YOLO, FOMO, frothy market to you, or is this exactly what you would expect given seasonality, given the fact that we just got through a presidential election, you got a red wave, and you have earnings continuing to power higher?
I think, before the election, the outlook looked really solid. We had good earnings growth. We're forecasting 11% earnings growth for next year. You have a Fed that is in the progress of a cutting cycle. That's a good backdrop. And the real question is, how much has that changed post-election? If I look at what the market is telling us, the market is telling us it's incrementally more confident in the growth outlook.
Okay. So what are you confident in? What would you be buying in this market right now?
Well, one thing we've been focusing on is, of course, the extremely elevated degree of concentration in the market and relatively elevated valuation multiples compared to history. But if you pair that with a pretty good fundamental backdrop, as I was just discussing, there should still be very attractive pockets of the equity market for investors to look at. And for us, one interesting and overlooked pocket is mid-cap equities. You have this big group of stocks. They trade with very large market caps, very high profitability, and most investors have completely overlooked them. And the result of that is they trade almost exactly in line with their historical average valuation multiples.
So in terms of the tech trade, obviously we got NVIDIA earnings this week. That was seen as kind of a key catalyst one way or the other for the broader markets. Didn't really play out that way because even though it was a beat and raise quarter, it wasn't as strong as investors were hoping and the street was whispering. And yet we're poised for gains for the major averages. So what does that tell us about the concentration you just talked about and thus the rotation we're seeing?
I think it's very clear that the Mag 7 or the AI stocks, whatever group you want to look at, the earnings growth continues. But it's also clear that the acceleration in that growth seems to be slowing. And likewise, the beats that we're seeing every quarter, they're getting a little bit smaller every quarter. And so investors are asking themselves, what's the next part of the AI trade? And we've been focused on software. We are calling that phase 3 of the AI trade. Basically, so far, investors have been focused first on semiconductors, then on the broader infrastructure, what we call phase 2, including electrical utilities. And we think now it's time to start looking at phase 3, which is mostly the software companies that can use AI to generate revenues for themselves.
Although the move lately has been out of chips and into software. So is that story already well understood by the street?
I think it's starting to be understood. Just this week we published our quarterly analysis of position filings in the hedge fund universe. We looked at almost 800 hedge funds. And of course, we saw something we see almost every quarter, which is the Mag 7 are the most popular long positions. But what we also saw is, on average, funds shifted a little bit away from those stocks and towards software. And this was really the first quarter where we saw that move take place.
So you think there's more to go on that?
We think it's just the beginning of this trend.
We've been making jokes about the 12-month index projections. A lot of them are around 6,500 S&P. Is that sort of a standard, let's give it 10% because so much of policy right now is not clear? What's on the way?
There's certainly a lot of policy uncertainty. We're trying to work with what we have and where we have clarity. As I mentioned earlier, one place we have clarity is the health of the economy and the health of earnings growth. Even before the election, we were forecasting about 11% earnings growth for next year. That corresponds with about a 10 or 11% return. Right. That's how we got to 6,500.
So the question then is, what is a baseline China tariff, right? No one really knows, although some base cases are taking it to 60. Yeah?
Our base case is smaller than 60. We're assuming a 20% tariff. On the other end, we're expecting some modest tax cuts, perhaps some deregulation. When we put that all together, we think it nets out to not a major change for earnings, but of course we'll be watching the headlines like everyone else.
Well, mid-caps and small-caps have benefited as a result of the belief that there's going to be a lower tax rate domestically, right? I mean, can that continue to play out?
Yeah, mid-caps benefit from, as I said earlier, strong earnings growth. As you said, they're relatively insulated from tariffs because they tend to be more domestic-facing. And yes, they're more exposed to the U.S. economy. So if there's deregulation, tax cuts, other factors that boost U.S. growth, they should continue to outperform. But we'll have to see what policies are implemented in late January.
It's a lot of wait and see at this point, isn't it?
I think that's right.
Yeah.
The other thing, a note from you guys in the last few weeks, which we talked a lot about, was the longer-term look at maybe suppressed returns over a decade relative to prior decades because of that concentration, and Costin's talked about that. Has that view evolved in recent weeks at all?
When we're looking out over 10 years plus, it shouldn't change very much week to week. It hasn't changed very much week to week for us. Really, we're trying to think about the world in two different investment horizons, right? The first is, what does growth look like? What does policy look like? What does that mean for investors in 2025? when I look out 10 years, it's very hard to know what the next administration will even be. So we're really thinking more about where are valuations today, where is concentration today, and it's hard to argue with the fact that those are very high compared to history.